Alrighty then. All ready to go. So, what we're gonna work on is first and foremost, we are going to review chapter 2, then we'll do chapter 3, then we'll do our exam 1 rework assignment, and then homework for chapter 2 and 3. So that's our lineup. So chapter 2, let's just finish up kind of is the goal here. Let me just go back. There we go. Because we finished our homework with this. We didn't read the whole chapter because it was boring. And not that, yeah. All right, so to recap, absorption costing. Oh, I hear a timer. All right. So absorption costing. Ow. All manufacturing costs, both fixed and variable. Now, absorption costing is approved by the GAAP, GAAP, a general something accounting principles, something like that. So it's basically a legal thing, right? Something that companies have to do. So generally they do it anyway. They might do something like variable costing, which is something that isn't approved by a GAAP, but absorption costing is basically taking, as you see to the right, all manufacturing costs, which is direct materials, direct labor, and manufacturing overhead, and using those to determine the costs for job costing. Now, job order costing is used in situations where many different products, each with individual and unique features, are produced each period. For example, a clothing would make different kinds of jeans, and it gives us an example of an order for 1,000 of these jeans is placed, and that's called a job. In the job order costing system, costs are traced and allocated to jobs, and allocated is a big word here. Allocated to jobs, and then the costs of the job are divided by the number of units, which gives us an average cost per unit. Basically, if we look to the right, manufacturing costs, as we are trying to figure out, okay, manufacturing overhead is all these really hard to figure out things. So we're going to create a way by making an allocation to a constant, like across all items, like direct labor. And then we'll find per hour for manufacturing overhead as specific as we can make it. But in this particular course, we are not actually going to be finding out what is the best way to allocate things. So anyway, moving on. Before we begin, yep, we already know this. Direct labor, what is it? Indirect labor, what is it? Recall that in absorption costing, product costs include manufacturing overhead as well as direct materials and direct labor. Needs to be recorded. Manufacturing overhead is really hard to do, basically. For example, if $20, oh, yeah, so this is talking about POER, to be able to find a predetermined overhead rate. Where's the H, right? What is, I'm so confused by that acronym, but, yeah, moving on. This is just some problems that it's working through. predetermined overhead rate times actual direct labor. So it's going to basically tell you this is the allocation. Like what's the best um, allocated like which should we focus on specifically to get the best estimate of manufacturing overhead costs? And so that's going to be selected for you, and then you just have to times that times the predetermined overhead rate, which we find out by dividing the total manufacturing overhead costs, which is the previous one we were just looking at. So we want all the overhead costs of manufacturing divided by whatever our allocated base is, all of our allocated base, is going to give us our POER, which is our predetermined overhead rate. And then using POER, we can times that by whatever our allocation is to find out the total cost we should charge. Sorry if that's confusing. Moving on. However, if an actual rate is computed monthly or quarterly, seasonal factors in overhead costs or in the allocation base can produce fluctuations in the overhead rate. For example, the cost of heating and cooling a factory in Illinois will be highest in winter and summer months, and lowest in spring and fall. If the overhead rate is recomputed at the end of each month or each quarter based on actual costs and activity, the overhead rate would go up in the winter and summer and down in the spring and fall. As a result, two identical jobs, one completed in the winter and completed in the spring, would be assigned different manufacturing overhead costs. To avoid such confusing fluctuations, companies compute actual overhead rates on an annual basis. However, with this approach, the manufacturing overhead assigned to any particular job would not be known until the end of the year. A cost driver, I had a problem with this. There's difference between cost driver and cost behavior. And not just that, what's the other one? Cost driver, cost behavior. Yeah, I think those are the two I'm thinking of. A cost driver is overhead costs. That's what it is. It's just another name for overhead costs. So you'll notice it says here, a cost driver is a factor. So basically, it's any of these things that we call overhead costs. But what it's saying specifically is a cost driver is something that causes overhead costs. It's something that causes overhead costs, which is another way of saying, you know, if I am doing machine hours, what is that? That's a cost driver. Well, what makes you say that? Well, it causes overhead costs. It's so dumb. I hate that. I have to remember that cost driver, this word particularly, means overhead costs. Bugs me. Okay, a cost system with multiple predetermined overhead rates. And what we're talking about here is multiple different product, right? In the example of the jean company, we have multiple different products, which means that we're going to use more than one overhead rate to apply overhead costs to jobs. For example, a company may choose to use a predetermined overhead rates for each of its production departments. Why wouldn't you? You don't want your jean section to be confused with your computer making section. They don't even use the same, materials or whatever. So such a system, while more complex, is more accurate because it reflects differences across departments in terms of how jobs consume overhead costs. For example, in departments that are relatively labor intensive, their overhead costs might be applied to jobs based on direct labor hours. So what they're talking about here, their overhead costs, we're talking manufacturing overhead, might be applied to jobs based on direct labor hours. So they are specifically saying, hey, the allocation base that we're using is direct labor because that is something that is going to be used no matter what, because what we do is build pools or whatever, right? Their overhead costs might be applied to jobs based on direct labor hours, and in departments that are relatively machine intensive, their overhead costs might be applied to jobs based on machine hours. So basically, what happens is you have these two different departments, and because they are both basically tailored to the specific role of that department, you're going to get a much more specified result. Um, I don't know if that's always true though. Like, I think this is kind of assuming, but it is important to emphasize that using a departmental approach to overhead application results in a different selling price for Job 407 than would have been derived using a plant-wide overhead rate. Yeah, so let's say I own, let's say my company is called Blue Hawk, and I own 8 call centers, one in California, 4 in Utah, and 5 in New York. If I have each of those call centers give me their results or their costs, right? Their costs of operations, and I go by cost of operations um, per those individual things, it's it's gonna be different. Like if I'm deciding, oh, how much is this call center in California making compared to New York, those are massively different job markets, right? Um, so deciding that could be potentially good. I think it could be potentially bad. Um, anyway, uh, what are they saying here? They're saying it's important to emphasize that using a departmental approach to overhead application results in a different selling price for Job 407 than would have been derived using a plant-wide overhead rate based on either direct labor hours or machine hours. The appeal of using predetermined departmental overhead rates is that they presumably provide a more accurate accounting of the cost caused by jobs, which in turn should enhance management planning and decision making. So let me put it this way. So the place in California, their cost of electricity is way higher than the cost in Utah, right? So but in Utah, I decide to give the same costs. Like how do I put this? You assume because of the data you're looking at, I think it's easy to assume that across the board it's that way. If I flip that, I don't think you'd have a problem if you went from California to Utah, but if Utah's the cheaper one and you're using that as your base, if you're assuming that they're all going to be that price, it's just stretched out. The better option as a company would be to say, hey, let's put all of our costs together and look at our total as a company. What's our average? And then let's do the average. Like, this is the cost of doing business as an average as a company. Let's move on from there. And I think it would be important for a company to have the high level view, which where you break it down and break it down even more, but maybe not a CEO level, right? Maybe not the shot callers, but definitely the managerial accountants should be looking at the differences between your different places or departments for sure. All right. Next, the existence of underapplied or overapplied overhead has implications for how a company prepares its financial statements. Absolutely. So, um, we said this earlier. At the beginning of each year, a company has to decide how much are we going to sell? Like, what is your goals as a company? What do you want, right? How much do I want to sell this year? How much money are we going to do we want to make? How many sales does that mean? How many now the opposite, right? This is a sailing approach and making money approach. obviously there's a cost of doing business to all that. So you need to consider, okay, well, how much is this going to cost us? How much direct labor, how much direct materials, how much manufacturing overhead is this going to cost? Now, in this course in Accounting 2020 at UVU, Utah Valley University, I do not have to figure that out. Um, Figuring out the numbers, that isn't even something that I don't think they'll teach me in college. It's something that I would just have to do research on and figure out, basically. But something that is rather important is being able to take like research and put it in. So what are the things that we need to consider? We're looking at costs of a business in this chapter, specifically job costing. So at the beginning of each year, a company would sit down and say, okay, so this is how many jobs we would do, or sales, whatever you do. Let's say I do sprinkler repair. I plan on doing 500 jobs. I did the math, or I looked at the job market, what's coming up, the prices of PVC, PVC, um, PVZ, yeah. The price of sprinkler heads, as I know, are going to be going up, so I estimated it to be this cost. So all these costs for jobs, right? I'm going to do 500 installs this year, right? And so I do all the math, and then I have these numbers. Now in this class, I won't obviously do any research or math or yada yada. All I'm going to be doing, I'm going to be given the math, saying, okay, so you guys project that you're going to do this. Cool. How do I figure out the predetermined overhead costs? Because I don't know how many indirect materials, indirect labor, or other manufacturing overhead costs are going to take. I don't even know how much direct labor it's going to take. Like, you know, we're totally guessing. And if I had a year's worth of data before or prior, I would use that from last year. Or if it's a brand new company, I am estimating, right? Well, I estimate that it would take me about this long. So this is what I would, this is what we're figuring out. The existence of underapplied and overapplied overhead has implications, right? When you, what this is saying is when you guess, and if you're under or over, what does that mean? So obviously, if you're under your estimate of overhead costs, right? We're talking about manufacturing overhead. So that's a number, it's going to cost me about I say $25,000. $25,000 worth of materials to do the 500 jobs, right? So it's going to cost me that much money to do the 500 jobs. So how do I get that job amount? Well, what does that money do? Well, if I'm under 25,000, that just means that my the if it's under applied, my cost of goods sold is raised and my net income lowers. That's what under applied does, right? I'm trying to think. This is so backwards. It's backwards. I just got to think about it for a second. Under applied, so I paid less than I anticipated in overhead. So I paid less materials than I guess it depends if your jobs are the same, because that could change. Let's read what it says here. Okay, so the existence of underapplied and overapplied has implications, of course, than your estimates. For example, the cost of goods sold reported on a company's income statement must be adjusted to reflect underapplied or overapplied overhead. You have to, if it's not as you said it would, you have to say, otherwise legally GAAP will get you. The adjustment for underapplied overhead increases cost of goods sold and decreases net operating income, whereas the adjustment for overapplied decreases cost of goods sold and increases net income. So my overhead costs, my manufacturing overhead goes up, my cost of goods sold is going to increase. No, it's going to decrease and my net income will increase. Overapplied, I applied too much. Ugh, so freaking confusing. When a company uses predetermined overhead rates, I knew this. It's just walking through it is such a headache. When a company applies less overhead to production, then it creates what is called underapplied. Less overhead to production. Oh, okay. Okay. So that is correct. So if I apply less overhead to production than it actually incurs, so basically if it's 25,000 is my guess, it's going to cost 25,000 for a year. So January comes around and I have to make a new income. We're going to do 500 jobs this year. My manufacturing overhead is going to be $25,000 for the year. It's a guess. It's going to be overapplied or underapplied, which means it's either going to be like 23,000 or like 27. I know those are guesses, but $23,000 is underapplied overhead. What that means is so I guess that it would be higher than that. So if it went lower, my cost of goods sold are going to be lower, right? Let me see. The adjustment for underapplied overhead increases. So I expected to pay $25,000 when in fact I paid less. When I increase that, my cost of goods will go down. I paid more than I thought. So what we're doing is we're comparing my estimate to the actual numbers, right? So my estimate's 25. If the actual cost was 23, I have underapplied overhead, which means that my cost of goods sold are going to increase. The adjustment is going to increase my cost of goods sold and decrease my net operating income because the price of my products are going up, which means that, of course, my net income is going to go down. When a company uses predetermined to apply overhead cost to jobs, it is almost certainly that number of overhead will differ from the actual amount of overhead costs incurred during a period. When a company applies less, it creates an underapplied overhead. When it applies more overhead to production than it actually incurs, it's overapplied. All right, job order costing in service companies. A chapter focused on manufacturing. However, job order costing is also used in service organizations. Good. Such as law firms, movie studios, hospitals are accumulated day by day on a job cost sheet as the client's case is handled by the firm. By attorneys is legal forms and similar inputs represent the direct materials for the job. The time expended by attorneys blah, is like direct labor, and the cost of secretaries and legal aids, rent, depreciation, and so forth represent overhead. All right. Underapplied overhead. Ah, it is backwards. The term underapplied overhead refers to a situation that arises when overhead expenses amount to more than what a company actually budgets for. What does that mean? What that means is my guess was 25,000, but it was actually 27,000. So to correct that, I need to increase my cost of goods sold, which is going to decrease the net income that I make. If I over applied, then my guess was 25,000, but my actual income or my actual costs were 23,000. So I over applied, which means that my cost of goods sold I need to decrease, which increases my net income. So I would say over applying my overhead is way better than under applying. My guess needs to be over. My guess doesn't want to be under. That's what that means. All right. Feel a heck of a lot better about chapter 2. On to chapter 3. All right. If you are just tuning in, welcome to the most boring Twitch channel that exists on the internet. What we are learning is accounting, managerial accounting. It is so boring, you will wish that you never clicked on this. All right. We are on chapter 3. Job order costing continued. Cost flows and external reporting. Business focus. Inventory accounting at Toll Brothers. Looks like houses. Toll Brothers is one of America's largest home builders with annual revenues in excess of $5.8 billion. The company's inventory consists of land acquisition costs, land development costs, and home construction costs. The overhead costs related to development and construction in accordance with generally accepted accounting principles, GAAP. Toll Brothers treats its inventory as a long-lived asset rather than a current asset because its master planned communities can take up to 10 years to fully develop. Interesting. While Toll Brothers industry has some unique attributes relative to most manufacturers, it is an industry well suited for job order costing. For example, each new home that the company builds can be accounted for as a job that gets assigned direct material costs such as lumber, shingles, and bricks, direct labor such as subcontracted electricians, plumbers, and roofers, and overhead costs such as costs of construction supervisors and the equipment that they use to perform their jobs. What are we going to learn in chapter 3? If you are even remotely interested in this, you will learn understand the flow of costs in a job order costing system and prepare appropriate journal entries for record costs. Use T accounts to show the flow of costs in a job order costing system. Prepare schedules of cost of goods manufactured and cost of goods sold in an income statement. Compute under applied or over applied overhead cost and prepare the journal entry to close the balance in manufacturing overhead to appropriate accounts. So, if you have taken accounting in college before, you will understand that this chapter pretty much sounds like financial accounting, which is something that we take in 2010 at UVU, Utah Valley University. And what that means is we are going to learn about balancing well, it's not a checkbook, but it's pretty much balancing a budget for a company. So, the financial, I mean, this is something, assets equals liabilities plus owner's equity. This is something that we're going to pretty much be doing today. Now, managerial accounting is these dots we see off to the right, assigning cost to cost objects, accounting for costs in manufacturing companies, preparing financial statements, predicting cost behavior in response to changes in activity, and making decisions. There's obviously a heck of a lot more to managerial accounting, but preparing financial statements, although financial accounting is something that is done for external parties, and managerial accounting is for internal parties. That being said, external information that's being given to others can be useful internally, not to mention it's legally binding. Like, you have to have it. So if you've already spent all this money to invest in making those, why not use it to your advantage? Why not learn about how you can use it, right? Which is what we're doing here in chapter 3. All right, so chapter 2 discussed how companies use job order costing to assign manufacturing costs to individual jobs. This chapter describes how companies use job order costing to prepare a balance sheet and an income statement for external reporting purposes. Again, even though this is for external reporting purposes, it costs money and time for a business to develop these, so it's important to have it. Okay, Exhibit 3.1 summarizes 7 important vocabulary terms that were introduced in the previous chapter. Please take a moment to review these terms, each of which is included in the glossary at the end of this chapter, because it will help you understand the forthcoming learning objectives. All right, let's go through these. Job order costing. A costing system. So there's other costing systems than job order costing, but a costing system used in situations where many different products, jobs, or services are produced each period. Period is, space of time. A costing method that includes all manufacturing costs, direct materials, direct labor, and both variable and fixed manufacturing overhead in the cost of a product. A measure of activity, such as direct labor hours or machine hours, that is used to assign costs to cost objects. A rate used to charge manufacturing overhead costs to jobs that is established in advance for each period. It is computed using the following equation. POER, I don't know why it's called POER. I don't know where the H, I think it's H. Yeah, predetermined overhead per hour. That's where POER, but yeah. So the predetermined overhead rate, you take your total manufacturing overhead costs divided by your allocation base, the total allocation base, right? Whatever your allocation base is, that's, in this class, we will be told what it is if we use it. So allocation base is something that can be determined. It could be direct labor, could be like machine hours. Those are probably the two that I'm going to see the most, so we'll stick with those examples. Absorption costing is GAAP approved. So that absorption costing, that is something that has to be done by law for if you're a publicly traded company, and it's a costing method that you, like it says here, costing includes all manufacturing costs and variable and fixed manufacturing overhead in the cost of a product. So you see this second bullet point, manufacturing and non-manufacturing. Well, I'm sorry, all the manufacturing costs are going to be a part of this. Now, variable costing is something done internally for you to determine, because obviously that's not very specific to an item, right? If you look at the manufacturing overhead, indirect labor, you're talking like factory janitors, factory mechanics, supervision, cleanup. This kind of stuff doesn't really apply to everything you sell. Um, or at least it may apply to some more than others. It's not, what we're talking about here is a gap principle that the reason it's is general is because it gets you close enough, right? People aren't going to sneak out. Publicly traded companies need to be really transparent. So having a system where it's like, hey, you need to give at least a general picture, it's and it's pretty decent. Like it's not it's not the it's not exact, and it never probably will be. Like, it's just the cost to come up with an exact manufacturing overhead amount would be insane. Like quantifying, look at this, quantifying the glue used to hold things together. Like, you make chairs, you have to use a certain amount of glue to keep the fabric on the chair, and then you staple it on as well, right? And are you going to count the amount of staples each chair took and then quantify that into the cost of the chair? No, that would be insane. Like, maybe Amazon does, but Amazon's crazy like that. So what I'm saying is, getting that specific is a little extreme. It costs a lot of money to do that, right? To have someone go count staples and quantify the weight of glue that was used on this product, that's ridiculous. That just costs so much money. So not doing that is a much better option. Um, so that's our absorption costing. Now let's look at our overhead application. The process of assigning overhead costs to specific jobs using the following formula. Overhead, yes. Overhead applied. So that's our predetermined overhead rate. Now, how do we get predetermined overhead rate? January, beginning of the year, or whenever that might be for you. That might not be January. But the end of your year for your business, you need to sit down and decide what your goals are for the year. If you're a brand new company, you have to do that too. You got to sit down and say, this is the goals we're having. So that's where your predetermined rate comes from, right? You have to decide how much you're going to sell your products for, but before you do that, you have to know how about this is total guess, um, educated guess. You're going to put work into this, but you are going to sit down and quantify about how much it's going to cost you to do X amount of jobs, because you're also going to decide how many jobs you're going to do, or services, or whatever you do. So you have to sit down, decide that. Now that rate, and this is specific to your manufacturing overhead costs, which are really difficult for you to pinpoint, so it's a guess, right? It's your manufacturing costs over the allocation base, which your allocation base needs to be something consistent through all your products, or per department. Your allocation base needs to be specific to whatever you're doing. So usually direct labor or machine hours would be, how long those would be good. Good examples. All right. So our predetermined overhead rate times the amount of the allocation base incurred by the job. So that tells us, so we do the math of the above one, our predetermined overhead rate at the beginning of the year. We have that. And then as we go through that year, we're going to have overhead application, which means that, hey, I got a job. It took about our labor hours, direct labor hours, to doing this sprinkler install was 50 hours, and based off of our math at the beginning of the year, it is going to cost $15 an hour for just our predetermined overhead rate. And we're talking manufacturing overhead, right? So that's indirect materials, indirect labor, and other. So we estimate that that is going to be $15 an hour, and it took us what, 5 hours or something. So you add those together and you get your overhead applied to that job. You add that overhead plus your direct labor plus your direct materials, and you get your absorption costing. Awesome. Normal costing. Here's another costing system. This is a costing system in which which overhead costs are applied to a job by multiplying a power by the actual amount of the allocation base incurred by the job. So what that means is you're going to take your year, January or the beginning of your work year, your guess, and you're going to times that by the amount of the allocation base incurred by the job, by the actual amount of the allocation base incurred by the job. So if you estimate that you were going to do 500 jobs, and that means you're going to do so many, 500 jobs, you're estimating the amount of direct labor hours. You estimate, let's stick with the sprinkler repair, right? I am going to do 500 installs this year, and that's going to take me roughly about, say about, for easy math, we'll say 10 hours a piece. So we got 1,500 hours of direct labor, right? 1,500 hours of direct labor is my guess about how much labor I'm going to do this year. So obviously, February, I'm doing, I hope no one's installing sprinklers in February, at least not where I live. May comes around and I do my first install. I know how long that was. So in a normal costing system, I would just take that overhead costs are applied to a job by multiplying my POER, which I determined earlier, by the actual amount of the allocation base incurred by the job, instead of my guess from the beginning of the year. Makes sense? Okay, and job cost sheet. A form that records the direct materials, direct labor, and manufacturing overhead charged to a job. This is also called an invoice. I don't know why they call it a job cost sheet. They do, I know why, because it's what it's called in manufacturing. Like if you place an order, it goes in the back end has a system that creates like the order, it sends it to this manufacturing part, and the manufacturers, the people that are actually in the factory, take that and make an order, and then someone fulfills that order. It's almost like the person that rings you up at the burger menu, in the restaurant, the waitress or waiter who takes your order, writes it down on a piece of paper, they give it to the person in the back, right? I mean, in this example, the person in the back would make the job cost sheet order, but it's not perfect, guys. All right, that's what I'm trying to say. All right, I think we're ready for the next page, and a glass of water real fast. Job order costing, the flow of costs. Feel the flow. Understand the flow of costs in a job order costing system and prepare appropriate journal entries to record costs. In Chapter 1, we used Exhibit 1-2 to illustrate the cost flows and classifications in a manufacturing company. Now, we are going to use a similar version of that exhibit as shown in Exhibit 3-2 to introduce the cost flows and classifications in a manufacturing company that uses job order costing. Very good. This is a great picture. I love this picture. It's just so easy to see the flow of things. So these are the things that we're going to work on. This is the balance sheet. This is the income statement. This is showing that I finished the goods. They're sitting in my um, they're sitting in my warehouse. I was gonna say in my inventory, which is true, but they're sitting in my warehouse, right? I finished my chairs in my chair company, and my chairs are sitting in my warehouse. And someone places an order online, it's sold. You know, the chairs go on to a thing, and they are gone. All right. So then, what am I doing? Let's see. Yeah. So once they're sold, um, I ship them. They get delivered. I don't know, depending on the company. I'm sure how that works for them. Um, but depending on that company, the items are going to be sold, and then they'll get transferred to my income statement because I sold them. I think as soon as the point of sale happens, that's when that would happen. Even though the items haven't necessarily left your warehouse at that point, and in your inventory, they are hopefully they're checked, they're gone, right? I would hope that the system has something like that, like you place the order and then it subtracts those items that were just ordered from the inventory that second that they were the point of sale happened and the money had been exchanged. I know that doesn't happen. I know that no system that I've come across, like Wayfair's system that I worked with, it doesn't work that way because they're working with other suppliers, and so their suppliers have their own web applications. So basically, Wayfair system is just re-updating itself in order to uh, display what's available. So it's got to re-update, like, you know, every few hours. It will do an update, and you know, it depends on their software system because, you know, you working as a company like Wayfair. Wayfair works with several different suppliers who work with other suppliers who work with other manufacturers, right? So the so that chain can happen several times. You could have a supplier who buys from a supplier who buys from a supplier who buys from the manufacturer. That chain can be forever long. Basically, it's just a company that's decided, hey, I can buy this from you and sell it to these people for a better price, like make money, without even storing the product. Basically, Wayfair's within Wayfair's within its inception, man. All right, or woman, whoever you are. All right, where were we? The most boring stream in the world. That's where we were. Um. Where were we? So I'm just making some changes real fast. Very good. Very good. I just want to make sure my stream says, oh, I didn't want that. There we go. Hmm. All right. Sorry, I got distracted for a second there. All right, where were we? Exhibit 3-2 shows that in a job order, In a job order costing, a company's product flows. A company's product costs, flow through three inventory accounts on the balance sheet and then on to cost of goods sold in the income statement. All right. Sorry, I'm distracted. Oh boy. All right. All right. All right. All right. All right. Let's get back to this. So Exhibit 3-2 shows that in job order costing, a company's product costs flow through the three inventories accounts, the three inventory accounts on the balance sheet, and then on to the cost of goods sold in the income statement. More specifically, raw materials purchases. Raw materials purchases are recorded in raw materials inventory account. Raw materials include any materials that go into the final product. What they're not talking about when they say raw materials are trees. Yeah, they're talking about like the prepared things, right? Um, in the final, well, I mean, it could be trees, I guess. It depends on what you're selling, right? You could be selling, maybe you're a manufacturer and you're actually cutting down the trees and you have tree farms. Maybe that is part of, that's what goes into your final materials, right? But you're definitely not talking about the nutrients, I guess, in the soil. I don't know. Maybe that's a part of it. Anyway, raw materials include any materials that go into the final product. Okay. So when raw materials are used in production as direct materials, their costs are transferred to work in progress. Um, so work in progress consists of units of product that are only partially complete and will require further work before they are ready for sale to the customer. All right. Um, Work in progress consists of units. Finished goods consist of completed units of product that have not been sold. The amount transferred from work in progress to finished goods is referred to as cost of goods manufactured. All right. Cost of goods manufactured includes the manufacturing costs associated with units of product that were finished during the period. So during the period, yep. As jobs are sold, their costs are transferred from finished goods to cost of goods sold. At this point, the various costs attached to each job are finally recorded as an expense on the income statement, which makes sense, right? You're not going to charge expenses until you sell things, right? Um, there's obviously companies out here that do that, right? There's companies in the world that do exactly that. But in general, accounting, generally accepted accounting principles or GAAP, you need to follow this this path here. So, um, as jobs are sold, their costs are transferred from finished goods to cost of goods sold. Okay, not before, not when they've been made, but when they are sold, that's when they transfer from finished goods to cost of goods sold. Obviously, something can't be in cost of goods sold if it's not been sold, which is the way I think about it. I'm sorry, I'm so distracted. Okay, back to it. As jobs are sold, their costs are transferred from finished goods to cost of goods sold. At this point, various costs attached to each job are finally recorded as an expense on the income statement. Until that point, these costs are in inventory accounts on the balance sheet. Period costs, or selling or administrative expenses, do not flow through inventories on the balance sheet. They are recorded as expenses on the income statement in the period incurred, as we see in the picture here. Selling and administrative. Always, there's no balance sheet record of these. They just go bloop over here to income. Period costs. These are product costs, period costs, product costs, period costs. As we can see over here, preparing financial, period costs, product costs. It's all consistent. It's all coming together. All right. To illustrate the cost flows within a job order costing system, we will record Ruger's Corporation's transactions for the month of April. Ruger is a producer of gold and silver commemorative medallions and worked only 2 jobs in April. Job A, special minting of 1,000 gold medallions commemorating the invention of motion pictures, was started on during March and completed in April. As of March 31st, Job A had been assigned 30,000 in manufacturing costs, which corresponds with Ruger's work in progress balance. And on April 1st of 30,000, Job B, an order of 10,000 silver medallions commemorating the fall of Berlin Wall, was started in April and incomplete at the end of the month. So what that means to me is, there's a lot of info here. Some of it that doesn't matter at all. But ultimately, we just need to keep in mind what happened what month. So in March, we started a job. In April, we finished a job. In April, we started a job. That's what I heard. So let's look. So we have purchase of issue of materials. So Ruger had 7,000 in raw materials on hand during the month of April. The company purchased an additional 60,000 in raw materials. This is debit, this is credit. So debited raw materials because debits increase what's in the account. Accounts payable. Now this is taking us back to financial accounting where we need to recognize that accounts payable is a credit balance. Um, Accounts payable is a credit balance, right? What that means is let me ask this. Is raw materials a asset or is it a liability? Raw materials is an asset. Is accounts payable an asset or a liability? It is a liability. So, I know this might sound confusing, but debits does not equal increase and credits do not equal decrease. They don't at all. Period. End of story. So, assets equal liabilities plus owner's equity, which means that raw materials is an asset, accounts payable is a liability. So, these have to equal each other. But I'm telling you, this column is debits, this column is credits, which means that accounts payable has to increase $60,000. Think of it this way. Our assets are increasing and our liabilities are increasing. They're both increasing, right? Is when you buy something, when you buy a car, maybe let's look at something that, I mean, you might think buying a block of, like it says raw materials, you might think that buying a steel rod is not a liability. That thing's never going to decrease in value. Where or it's never going to get destroyed, or I think people think of liabilities differently than business thinks of liabilities. Liabilities are things that have cost money and haven't, anything that isn't making you money is a liability that you've paid for. You know, that anything that you have in a company that you've paid for and isn't or hasn't made you money can be classified as a liability. It doesn't have potential of making you money. Raw materials has no potential at that time to make you money. You can't sell the raw material. I mean, you can technically sell the raw materials, but as long as they're raw materials, they're not thinking of making a product. It's more of like, this raw material isn't going to make us money as a company. Can we break even by reselling it? Maybe, maybe not. But you're liable for $60,000 that you just spent on this material. It's not going to make you money until it's a finished product. So raw materials is a debit account. It's increasing because your assets just increased. Your inventory just increased 60,000. Your accounts payable, which is a credit balanced account on the liabilities section, it just increased 60,000. Remember, raw materials is an asset account, thus raw materials are purchased and they're initially recorded as an asset, not as an expense. All right, issue of direct and indirect materials. During April, materials requisition forms were prepared to authorize withdrawing $52,000 in raw materials from the storeroom for use in production. That's a weird way to categorize your. I mean, the way this is worded, so you look at a form, usually, even in an invoice, right? You're going to get a form and it's going to say this product, this many product, the total costs of these, like going to IKEA, for instance, right? Like that's because, IKEA is kind of set up as a warehouse for consumers, kind of. So you go to IKEA and it's like, oh, you need to go pick up the legs for the stool, and then the back for the stool, and the seat for the stool, and each of those parts are going to cost, each leg is going to cost $1 a piece, and the seat will be $5, and the back will be $2, right? And you get that invoice, or the materials requisition form, and you are authorized to go buy that because it's IKEA and they want you to. Um, but that's pretty much what this is, right? It's just weird to me when they say we're prepared to authorize withdrawing $52,000 worth of raw materials, and it's like, oh, there'd be more on that form. There'd be date, time. I would rather have like an example of what that looks like, but whatever. These raw materials included 50,000 of direct and 2,000 of indirect materials. Now, I have this handy thing to our right of indirect materials like glue, used to hold things together, and direct materials, which is like the wood or the metal or the paint, like the legs. For instance, if your chair said, oh, you need to pick up a tube of glue for your chair, and this is supposed to, you're supposed to pour it in the holes of the seats when you connect, when you push the back into the holes in the seat, you fill it full of glue first so it will bind or something. So here we go. So work in progress is going to be $50,000 and manufacturing overhead will be $2,000. That's interesting that the direct materials is in work in progress. Let's read at the bottom. The materials charged to work in progress represent direct materials for specific jobs. These costs are also recorded on the appropriate job cost sheets. This point is illustrated in Exhibit 3-3. Here, work in progress. Okay, materials requisition form. We have direct materials. Balance 20 or balance 30, balance 0. Oh, job A, job B. So I'm gonna have $22,000. The job cost sheet is abbreviated. Yep. Yeah, and this is just showing that the raw materials, we did a debit to raw materials, so this is now 67,000. We did a credit to raw materials, which means basically these job cost sheets needed direct materials, which is raw materials, and we pulled that. We debited work in progress, increasing work in progress. Now it's not showing us the credit, like when we bought these. When we added this, there was also a credit to accounts payable, or where, notes payable, or wherever we made that purchase. Where was it? Is it accounts payable? Yeah. Anyway, the $2,000 charged to manufacturing overhead in entry 2 represents indirect materials. Good. See transaction 7 is always used to record manufacturing overhead applied to work in progress. Indirect materials, manufacturing overhead. Just like we see here. Work in progress, direct materials. That's the one I'm going to have to remember because this one is literally the same. So direct materials go to work in progress. Excuse the yawn. Like I said, this is the most boring stream on Twitch, so got to keep it boring. Labor cost. In April, the employee time tickets, which provide hourly summaries of each employee's activities throughout the day, include 60,000 recorded for direct labor and 15,000 for indirect labor. The following entry summarizes these costs: work in progress, manufacturing overhead, salaries and wages payable. Only the direct labor cost of 60,000 is added to the work in progress account. At the same time that direct labor costs are added to work in progress. They are also added to the individual cost sheets shown as Exhibit 3-4. During April, 40,000 of direct labor costs was charged to job A. Okay, hold up. What are we saying here? Only direct labor is added to work in progress. At the same time, okay. Yeah, that makes sense. Indirect labor goes here like it normally does. Right there. And then direct labor and direct materials both go into work in progress. Also, salaries and wages payable are being credited, which makes sense. All right. Oh, this boring stream on Twitch. All right. Look at the. I'm bored, but what are you gonna do? Look at Bangladesh's 20 million garment. All right. I got a bit of time. We're gonna just take a 15-minute break. It'll be 15 minutes. I'll be back. I'm gonna put that in the chat, even though people won't see it. Can I add a text? Oh, guess not. All right. Well, I'm gonna just do this screen and change this script here to 15 minutes. There we go. Even though the stream's been running. There we go. Be back. Be back in a bit. All right. We are back. We're going to take another break in a bit as well, but let's continue our chapter 3 smart book. Woo! Most boring Twitch streamer that exists. Welcome back. All right, where were we? All right, here we go. All right, purchase issue of materials, right? Raw materials, accounts payable, and then we had work in progress, manufacturing overhead, and raw materials. So it's moving from, so we purchase raw materials, and then once we start working on it, then we have work in progress. So it's moving from raw materials, which we are now, of course, crediting, and we are debiting work in progress and manufacturing overhead. And then, which, if we go back here, raw materials and work in progress inventory are on the balance sheet. They are not on the income statement. So we're just moving places on the balance sheet. All right. Only direct labor cost of 60,000 is added to work in progress account, direct labor and direct materials. At the same time that direct labor costs are added to work in progress. At the same time that they're added to work in progress, they are also added to individual cost job sheets. During April, 40,000 of direct labor costs was charged to job A, and the remaining was job 2B, whatever. All right. Let's look at this example. In Bangladesh, a minimum wage of $38. The minimum wage is $38 per month. A highly skilled sewing machine operator may earn as much as $100 per month before considering overtime. Companies such as Fakir Apparels, a t-shirt manufacturer in Bangladesh, can readily attract customers such as Walmart, Gap, and Primark due to these low labor costs. However, in addition to serving mass market retailers, Fakir Apparels also makes t-shirts for premium brands such as Tommy. All these. While the manufacturing cost for one of their t-shirts ranges from $1 to $6, the retail selling prices for these t-shirts can vary from $6 to $91. All right. Manufacturing overhead costs. Recall that all manufacturing costs other than direct materials and direct labor are classified as manufacturing overhead costs. These costs are entered directly into the manufacturing overhead account as they are incurred. To illustrate, assume the Ruger Corporation incurred the following general factory costs during April. Utilities, heat, water, and power, rent on factory equipment, miscellaneous factory overhead costs. Total is $40,000. Following entry records these costs. Recall that, let me say this again because I don't think I'm kind of spacing. Recall that all manufacturing costs other than direct materials and direct labor are classified as manufacturing overhead costs. These costs are entered directly into the manufacturing overhead account as they are incurred. Yes, we do know this. Okay. Yeah, and these are all general factory costs, so manufacturing costs, right? Manufacturing overhead, accounts payable. Basically, we need to pay up for these, right? Property taxes payable, prepaid insurance. Other things, these are other things we gotta pay. Accumulated depreciation. Okay. Because actual manufacturing overhead costs are charged to the manufacturing overhead account rather than to work in progress, it begs the question, how are manufacturing overhead costs assigned to work in progress? The answer is they are assigned by using the predetermined overhead rate, which is calculated by dividing the estimated total manufacturing overhead costs for the period by the estimated total amount of allocation base. For example, if we assume that machine hours is the allocation base, then overhead costs would be applied to jobs by multiplying the predetermined overhead rate by the number of machine hours charged to each job. To illustrate, assume Ruger Corporation predetermined overhead rate is $6 a machine hour. Also assume during April 10,000 machine hours were worked, so $60,000 on job A, and 5,000 were worked on job B. Okay. So 30 and 60, so 90. Thus 90 in overhead cost be applied to work in progress. The following entry records the application of manufacturing overhead to work in progress. Okay, cool. So I guess you would do that at like the end of the month, right? You would just kind of like as it shows, you add up all those manufacturing overhead, put the 90 there, and then add it to work in progress to kind of keep consistent with what we've done in chapter 2, at least. Yeah, the concept of clearing an account, right? Like at the end of the month, you clear it. Actual overhead costs are charged to this account as they are incurred throughout the period. Overhead is applied to work in progress using the predetermined overhead rate. Just like we did here. Yeah. This is kind of just saying like, hey, just remember that these are the year estimate that is made at whenever the beginning of your year is, and this can change quite a bit. So keep in mind that it can change using technology to improve manufacturing efficiency. All right, non-manufacturing costs. Companies also incur selling and administrative costs. Should be treated as period expenses and charged directly to the income statement. Non-manufacturing costs should not go into the manufacturing overhead account. Because they're not manufacturing overhead. To illustrate the correct treatment of non-manufacturing costs, assume that they have 30,000 selling and administrative costs. Okay. Boom. Assume that depreciation on office equipment. All right. To the difference between this and entry 6. All right, we're debiting advertising expense and other, and then we're crediting accounts payable. Cost of goods manufactured. A transfer of costs is made within the costing system that parallels the physical transfer of goods to the finished goods warehouse. Right. The costs of the completed job are transferred out of work in progress account into the finished goods account. Excellent. Cost of goods sold. If an entire job is shipped at one time, then the entire cost appearing on the job cost sheet is transferred to cost of goods sold. However, Sometimes, a lot of times, only a portion of the units involved in a particular job will be immediately sold. In these situations, the unit product cost must be used to determine how much of the product cost should be removed and charged cost of goods sold. Accounts receivable, 225, sales, 225. Cost of goods sold, 118, finished goods, 118. Okay, and this is everything right there. The schedules of cost of goods manufactured and cost of goods sold. All right, at this point, we're going to questions. I can't take it anymore. It's too boring. Too freaking boring. Which of the following statements are true? When materials are purchased, they are recorded in raw materials. Inventory account. That sounds true. Raw materials inventory only includes the cost of direct materials. Yeah. Raw materials inventory represents the cost of materials not used in production. Again, yes. Direct labor costs flow through. Nope. Actually, yes. No. Raw materials include any materials that are used in production, both direct and indirect. Oh, only includes. That's so dumb. So dumb. You got me. The journal entry to record the purchase of materials, credits, accounts payable. When labor costs are incurred, both indirect, only direct. Manufacturing overhead consists of all costs other than direct. Yeah. Really? Manufacturing costs other than direct labor and direct. These are the. What? Okay. Let me read this. Manufacturing overhead consists of all costs other than direct labor and direct materials. Manufacturing overhead consists of all manufacturing costs. Oh my freaking, are you okay? You know what? When we're saying manufacturing overhead, I assume we're talking about manufacturing costs because it is literally a manufacturing cost. It's nowhere else. Ugh. Like I assume when I say manufacturing overhead consists of all costs other than direct labor and direct material, I assume we're talking about the costs of manufacturing. Considering that you just referenced direct materials and labor, why would I assume that you're talking about, oh, I don't know, administrative costs and selling costs? Because those are in non-manufacturing costs. It's so frustrating. The journal entry to record 10,000 in manufacturing overhead applies to job number 40 debits. The journal entry to record 10,000 in manufacturing overhead applies to job number 40. Manufacturing overhead. I don't know what job number 40 is, but that sounds right. that will go into finished product are first recorded in the I want to say work in progress, but I think it's just raw materials. I mean, both would be right, I guess. A journal entry to record the purchase of materials debits. Raw materials. Selling and administrative costs incurred are treated as oh, that's a good question. I mean, they're treated as period expenses. I know that for a fact. Labor costs charged to manufacturing represent indirect, yeah. When a job is completed, its costs are transferred into cost of goods sold. I swear. Manufacturing overhead costs include factory insurance, not that, probably that. I'm going to say the salary of that factory worker. Factory insurance and factory supervisors. I thought the office equipment was a little iffy. Okay, we're going back to the questions though. Which account is credited when manufacturing overhead is applied? I clicked that on accident. Which account is credited? That's manufacturing overhead is applied. So when I'm adding manufacturing overhead, hmm. I knew that was wrong. I'm so lasered. All right, here we go. I gotta wake up. Which of the following statements are true? When materials are purchased, they are recorded in raw materials inventory account. Which of the following statements are true? When materials are purchased, they are recorded in the raw materials inventory account. Direct labor costs flow through raw materials inventory account. Okay. When materials are purchased, they are recorded in the raw materials inventory account. Man, this is a struggle, man. It's a struggle. Holy cow, it's a struggle. Which of the following statements are true? When materials are purchased, they are recorded. True or false? When materials are purchased, they are recorded in raw materials inventory account. That is true. Direct labor costs flow through the raw materials. Right. Raw materials inventory represents the cost of materials not used in production. Raw materials inventory only includes the cost of direct materials. Raw materials inventory only includes the cost of direct materials. Yes. Where's the cost of materials? Yes. Oh. Raw materials include any materials that are used in production, both direct and indirect. Look, I can't help that your questions are just so much harder than the last chapters. It's like all these little catchy things. Which of the following would not be charged to manufacturing overhead account? Factory rent's on there. That's on there. Definitely non-manufacturing costs. Stuff like that, man. I'm just so tired. I'm like functioning at like 2% my brain power. Consisted of 1,000 units at a total cost of 200,000. The cost transferred to cost of goods sold for the sale of 600 of the units is so 300, or I'm sorry, 500 would be 100,000. When a job is completed, the job costs are transferred out of the finished goods. Work in progress. Actual manufacturing overhead costs are recorded in manufacturing over account. Can't remember if it's as they are incurred. Yeah, as they are incurred. Manufacturing overhead is applied with a debit to accounts payable. Okay. I'm gonna go take a break. I'll be back. The longest bio break known to Twitch. All right. Yeah, we were here. All right. Check. A journal entry that debits work in progress and credits manufacturing overhead is recording the completion of a job application. Yeah, we're applying the manufacturing costs. Oh my gosh. Easiest question. Any purchase materials that will go. Pretty sure I already answered this. Raw materials inventory was 5,000 at the beginning, 12,000 at the end. During the year, total of 27 raw materials were purchased. 25, what is that? 20 or 32,000. Beginning of the year, 32 minus is 20. Oh. Minus 12 minus 4,000. 16. When only a portion of the units involved in a job are sold, the unsold units transferred to another job. Yeah, it's only a portion. I think that's it. The transfer, all right. Let's get back in this. Okay, true or false? The transfer of costs from one inventory account to the next parallels the physical transfer of goods from one inventory to the next. I mean, all right, let's think about this. Well, let's read about this because I don't want to think. Hey, it says that it parallels. It's good enough for me. Overhead is over applied if actual overhead is less. Over applied means that our overhead guess was higher than the actual. Manufacturing overhead costs include what side of manufacturing overhead account is applied manufacturing entered on? I don't really know. It's the credit side. Hmm. When calculating the cost of direct materials on the schedule of cost of goods manufactured, the cost of indirect materials is subtracted all right. The cost of indirect materials is subtracted from beginning raw materials inventory. Added to beginning raw materials inventory. Added to raw materials used in production. Subtracted from raw materials used in production. Oh my gosh, man. Just like spacing out. Calculating the cost of direct materials in the schedule. The cost of indirect materials is hmm. What side of manufacturing overhead account is actual manufacturing overhead entered on? Okay. Dude, I'm getting bamboozled. I am getting bamboozled. Bamboozled. Actual manufacturing overhead is debited. I'm gonna get bamboozled, watch. Yep. Bamboozled. Alright, that was absolutely horrid. Horrid. I'll have to recap on chapter 3 tomorrow for sure. Alright. Alright. We're gonna start a new Google Sheet. Or Google Doc, whatever. I'm gonna break Google Docs. You know what? This is the probably the fastest way to do this. All right. All right, there's that. Boring as heck. All right, which of these following statements is false? Okay, first thing, I'm gonna open up, go back to the McGraw-Hill. We're gonna go to our book. Selling costs include all costs that are incurred to secure customer orders and get finished product to the customer. These costs are sometimes called order getting and order filling costs. Examples of selling costs include advertising, shipping, sales, travel, sales commissions, sales salaries, and costs of finished goods warehouses. Selling costs can be either direct or indirect costs. For example, the cost of an advertising campaign dedicated to one specific product is a direct cost of that product, whereas the salary of a marketing manager who oversees numerous products is an indirect cost with respect to individual products. So, selling costs can be either variable or fixed costs. Selling costs are included in manufacturing overhead. Selling costs are included in a contribution format income statement. Hmm. Mm-mm-mm. Hmm. Variable selling, fixed selling. So I think this one's selling costs are included in manufacturing overhead. Oh, this is sad. All right. Okay. Class cost classification used to prepare GAAP financial statements, balance sheet, income statement include product cost and period cost, variable cost and fixed cost, relevant cost and irrelevant cost. Mm. Ugh. Why not? These costs distinguish um, there we go.